So we're starting to get busy with taxes for this season. And as more people are talking to me about filing their taxes this year, one of the common questions that everybody's asking is, what about 2026? What has changed? What should I do this year? So obviously we have an entire year to do tax planning, so it's not urgent, but I thought maybe I'll just put it up in a video format to tell you some of the important changes. So that will kind of get you started thinking about, what your tax situation is going to look like for the next year. So let's get started. Simplest one is the enhanced standard deduction. In 2026, the standard deduction has now increased. For example, single filers now have $16,000 deduction. Head of household is about $24,000. Married filing jointly is about $32,000. Now you might be going like, okay, so what? What does that mean for me? So let's say you earn $100,000 this year. If you're single, you automatically get $16,000 deduction, meaning you only pay taxes on $84,000. If you're married, that deduction doubles to $32,000, leaving you with just $68,000 of taxable income. That's pretty good, right? Now think about, for example, maybe you want to put your kids on payroll, maybe a family member on a payroll, maybe they're on your board of advisors, they're helping you out with your business, maybe in real estate or a side hustle that you have going on. So it kind of helps us move the money from you to somebody who's in a lower tax bracket. So that has an enormous ROI. But anyhow, that's a topic for another day, but just kind of putting some thoughts out there for you. So, math is simple. Bigger deduction equals less taxable income, which equals to lower taxes. Someone in the highest tax bracket with $30,000 deduction could save over $11,000 in taxes just because of this. So this is good. Now, seniors, some of you guys might have parents that you're helping them file their taxes, or maybe you're a senior yourself. So if you're over the age of 65, you get an additional $2,000 to $3,000 deduction plus hear me out, a new $6,000 bonus deduction for each qualifying senior, depending on the income level. So the question I got to ask you, especially if you are a small business owner, do you have any family member? Do you have parents? Maybe can you include them on the payroll? Can we issue them a 1099? Can we do something to move some income to them? It's good for them, and most importantly, it's good for you because you get to save on taxes and they get to save on taxes as well. So when this year, when you come talk about tax planning, this is one of the areas that I will be discussing quite a bit. Number two, I think many of you guys who live in a high state tax area like California, you're going to love it. The state and local taxes, commonly known as SALT. So SALT deduction got a major upgrade this year. If you earn under $500,000, you can deduct up to $40,000 in state and local taxes. Now, when I say state and local taxes, means your state income tax, the county income tax, property tax on real estate and vehicles, even sales tax in certain cases. So if you live, for example, in New York, Illinois, or my favorite, California, this deduction alone could be worth thousands of dollars. So make sure you're tracking every state and local tax you pay throughout the year. It will add up quite a bit. So make sure you create like a Excel sheet and you document everything. You try to keep the receipts and everything. So when you go to your tax professional to help you out with taxes, you got all the SALT deductions in one place. Now, retirement accounts. So, basically you paying yourself to reduce your taxes. That is what we call retirement contribution. So depending upon your situation, how we set you up, you can deduct up to $8,600 traditional IRA contribution. So remember, this year, it's $8,600. Up to $80,000 in traditional 401k contribution. And that includes employer match. I know some of you guys might be going, wasn't that 23,000? That's a common number that is thrown out there, but in reality, you can go up to $80,000. So imagine if somebody earns, $120,000, for example, married filing jointly, they can take the enhanced standard deduction and then they can contribute $80,000 into their 401k. Again, not all of it going to be completely tax-free, but it can have a big impact on your tax situation overall. Now, up to $290,000 can be put into cash balance or a defined benefit plans if you own a business. So many of you guys who are able to generate great cash flow in your business, maybe you don't have a cash balance plan or a DB plan set up. So please reach out to me and let's talk about that this year. So A, it saves you on taxes right away. And then more importantly, you're building wealth for your future as well. Now, these limits apply per person. So for example, if you have a spouse or a children who can participate, you can stack up on all of these benefits. So, I'll just take the traditional IRA. You can contribute, your wife can contribute, your kids can contribute, your parents can contribute. So you see how it really all add up. So this is the kind of stuff we do in planning, to see how much of this tax-free or future tax-free contribution we can make. Another one that comes to mind, we have had this since President Trump first term, known as the QBI deduction, and I'm glad it is still here to stay. 20% QBI deduction. Now, this is the most powerful deduction in the tax code. Well, I shouldn't say most; there are many other, but this is probably the most commonly used powerful deduction because everybody wants to use it, and you can expect to save a tons of money. So the qualified business income QBI deductions gives you an automatic 20% write off your business earning. So it's not for W-2 employees. You got to have a business. You got to have a business income. And let's say your income is $100,000. 20% of that, you don't pay any federal taxes on it. So that's pretty cool. So if you have a $200,000 in qualifying business income, you instantly get $40,000 deduction. So for someone who is in a higher tax bracket, that can be a lot of savings. So make sure you don't miss out on that. You might ask, well, Deepak, who qualifies for this 20%? So do I have to have a C Corp? Do I have to have a business entity set up? Do I have to have a real estate? How does it work out? Yeah, so a lot of people can qualify for it. If you're an independent contractor, you're a freelancer, you're a small business owner, you have a 1099, all of those are good. Now, if you have a C Corp, then you are not going to qualify. Now, there's one more thing you got to keep eye out for is income. So some of the high income earners in certain professions, like doctors, lawyers, contractors, these people would not qualify either. So this is really smart move. Some business owners are restructuring their entities specifically to maximize this deduction. So if you want to learn more about this, reach out to me and we can have a conversation, especially if you haven't been taking advantage of QBI on your tax return. Vehicle tax deduction. I think this is going to be something amazing this year. People are going to love it. Now, this is one area where things are going to get really interesting. There are two major vehicle deductions that you got to know about, right? So there's a personal vehicle interest deduction. So if it's not for business use, you can deduct up to $10,000 of interest paid on a car loan if the car was assembled in the US. Now, again, this is for personal purpose, nothing to do with your business. Now, if you have a business, so if you use that particular car or truck more than 50% for a business use, you can deduct 100% of the purchase price in year one. This is what we call the bonus depreciation. Wouldn't that be wonderful? I can already imagine how many business owners are probably going to buy new cars this year. Now, do you have to take it? Not really. There are two options. You can take a mileage deduction, about 32 cents per business mile in 2026. So let's say if you drive 10,000 miles, that's about $7,250 in deduction. Or you can claim an actual expense. You can deduct gas, you can deduct insurance, repairs, maintenance. And this is where it comes in. This is where you can also take 100% bonus depreciation. So what I'm trying to tell you is you cannot mix things up. You can't say, well, this car, I'm going to use it for personal and business. So I want to write off $10,000 in interest. Okay. And I want to claim mileage. That's not going to work. You're mixing two things together. Similarly, if you want to claim a bonus depreciation, then you cannot claim mileage either. So it has to be the actual expense or it has to be a mileage deduction. We need to clearly mention whether that car is for personal use or the business use. But I guess no matter which way you go, it's a win-win situation. So I'll give you a simple math. Let's say you buy a truck for $75,000, maybe one of those Tesla truck. I don't know how much they cost, but let's make it up. Let's say $10,000, and you actually have a $10,000 in actual expenses. So, and when I say actual expenses, meaning, well, I guess Tesla wouldn't have a gas, but maybe some electric cost, charging cost, insurance, repair, maintenance, that kind of stuff. So let's say you have $10,000 in actual expenses. you can write off $85,000 of your business income. We claim it as a bonus depreciation. So that's pretty good. And we get to write off $10,000 in the actual expense. Isn't that cool? I get to write off the bonus depreciation and the expenses. So this is pretty cool. Now, if you're in a higher tax bracket, hey, that's a big bonus. I mean, what? That's what, $30,000, $31,000 in tax saving. I'm sure you're going to love it. Now, some of you guys might be wondering, well, isn't bonus depreciation for more than that? Of course. Bonus depreciation doesn't stop at your car and truck. It applies to pretty much any business equipment or machinery you purchase. For example, maybe you're thinking about buying a new computer, software, cell phone. Maybe you're setting up a new office. You need to buy some furniture there, heavy machinery. If you have specialized equipment that you use, instead of deducting these purchases over lifetime, sometime we and depend upon what items, some items might be 5 years, some might be 10 years. So instead of waiting for 10 years to claim all of those expenses, now you can write them all off in year one. So, I mean, I have a lot of clients who are taking advantage of this. This is one of the great way to reduce your taxes this year. And then real estate. You guys know real estate is our favorite, right? This is where the wealthy people play the game. Real estate offers some of the best tax write-offs in the entire tax code, and the new rules are even more powerful. So let's talk about some of the basic stuff. So improvements and renovations. So some of you guys, like for example, I have a couple of clients, they buy land and then on top of that land, they build these homes. And these days you can buy a pre-built home or like a box home, stuff like that. So those kind of homes, they can be actually depreciated in year one. So these properties are classified for 5 years, 10 years, 15-year period. And as long as they're one of those, you know, uh, for example, and even if they're not, let's say if you have a regular home, then you might have some things that might be 5, 10, or 15 years life period, like for example, appliances, flooring, furniture. So anything that we can depreciate over the 15 years, we can now deduct them 100% in year one. So that's pretty good. So let's say if you're spending about $50,000 on qualifying improvements, you can deduct all of that expense. So one of the ideas I can give you for 2026 is think about a place where mortgages are really expensive. People spend a lot of money on mortgages, and you're able to buy a land and put maybe a couple of these kind of properties on it that you can rent out for a very good rate. So, A, you're going to make nice little rental income, but more importantly, you get an immediate ROI on your tax return. So, look into it for 2026. I think that will be really good. I'll just give you a simple example. Let's say you buy a property for $400,000 and there are these components inside like appliances, lighting, floating, all of that kind of stuff, and let's say they add up to $100,000. So now we can claim that $100,000 off your tax return. So that's a immediately, depending upon what tax bracket you are in. Let's say you are in 37%, that's $37,000 in tax saving. So we do this by using something called cost segregation. During the cost segregation, we identify every component in your property that qualifies for, let's call it, accelerated depreciation, because technically you're supposed to take it over a longer period of time. But thanks to President Trump, now we can claim it right away. So if you need some help with getting that cost segregation done, or you need help with some of these strategies, then give me a call. Let's talk about it a little bit in private and see what your situation look like. So anyhow, those are some of the big areas for 2026. Now I know some of you guys are W-2 employees, some are 1099, some are S Corp, C Corp. So you probably have a lot of different things going on. So I wouldn't really go jump on anything just yet, but this is just to kind of get you a taste of what we have for 2026. So if you want to set up a consultation, give me a call. Just go to taxcodeadvisors.com and reach out to me from there, and let's talk about some of these things in more detail. All right, guys, thank you so much, and I'll see you soon.